This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
This chapter deals with a special set of rules that the Revenue have put into place to decide when and how sole trader profits are going to be taxed in each particular tax year. So the tax year that we are dealing with is 22-23. Those are the dates. It runs from the 6th of April 22 to the 5th of April 23. Now, if you were employed, you would be given at the end of the tax year to work out what needs to go in your income tax computation. At the end of the tax year, you would receive a form P60, which would show exactly how much you'd earned in that tax year and exactly how much tax you'd paid. If you'd got benefits in kind, which we will come to in a different chapter, then you would receive a form P11D, which would show exactly what you need to put on your income tax return, your income tax computation for that tax period. If you've got bank interest, you'll get a certificate for that period of time. If you have income from your shares in the form of dividends, then they would have a date on them. And you would check the date that it ran between the 6th of April and the 5th of April 23, that the date was between those two dates included in your income tax computation. Add them all up. Sole traders, it doesn't work because not everybody has a 12-month accounting period that fits exactly in that time slot. Some people have 31st of December or 31st of October. All of those dates, they need to work out which set of accounts. So is it at December 22 or December 23 that we put in this set of this income tax computation? So these rules have been brought into place to work out when and how we work that out. Now, they are not the easiest rules in the world to learn, but once you've clicked, once you've done it, and it will take practice, it will take a lot of practice, but once you've clicked, it'll make sense to you. Okay, so we're going to go through these rules, nice and simple, nice and easy. Now, to get to this point, we have done several things. One, we have adjusted profits. So we've taken the profits that we've been given from the set of accounts for whatever period of time, and we have adjusted them for tax purposes. So we have added back depreciation, gifts that are food, entertaining of clients. We have taken out of their additional income. All of those are dealt with in a separate chapter. And you need to have understood that chapter before you deal with any more with this. So if that's the case and you haven't done that chapter, then you need to stop this lecture now, go back and do the adjusting profits chapter first. Otherwise, some of this might not make sense. Okay. We also did capital allowances, which we then took off our adjusted profits. Now, that chapter also you should have done before you're doing this one. So if you haven't done those two chapters, please will you pause this, go back and do them, and then come back to this chapter afterwards. They should be done. They are in the manual in a logical order, and you need to do them in that order in order for them to make sense. And I will assume that you have done that before you come to this. So, as it mentions in the first paragraph there, having adjusted the trade profits for the accounting period, computed, i.e. worked out, and deducted the capital allowances, the tax-adjusted trading profits must now be included in the income tax computation. So these are special rules. It says now, the problem is that not all traders prepare their accounts to the 5th of April. So the basis of assessment, i.e. what are we going to put in which tax year, is required that allows the revenue to relate the accounting period to the tax year, because sometimes they don't match up. So, for example, if our year end was the 31st of December 22, then some of that profit falls in this tax year, but some of it was in the previous one. How does that work? So these are the rules that we need to learn, and it's what's known as a current year basis, which is what I've explained there, and it's the accounting set of accounts that ends in the tax year. All right. So if a trader prepares his accounts to the 30th of June each year, his 22-23 assessment will be based on the tax-adjusted profits for the accounting year ending the 30th of June 2022, as the 30th of June falls in that tax year. So that's our tax year from the 6th of April to the 5th of April, and the 30th of June 22 is between those two dates. So that is what's known as a current year basis. Seems simple so far. Go with it. Okay, Andrew has been trading for many years, prepares his accounts to the 31st of March. Now, one thing that is important with this, 31st of March is treated as being the same as the 5th of April. It's called coterminous. They are the same date. So you don't have to account for 6 days of profits. Revenue accept that the 31st of March, 5th of April, treated as the same. Okay. So in what year will 31st of March 23 be assessed? Well, that falls, if that's your tax year, 6/4/22, 5/4/23, then that date is just about there. So it will fall in 22/23. Okay, now B. Eric has been trading for many years and he prepares accounts for the 31st of August. 31st of August 21. Okay, well that fits in a tax year, but it fits in this tax year. It fits in 21/22, somewhere abouts there, between the 6th of April 21 and the 5th of April 22. So it falls in the 21/22 tax year. Okay. Now, Kathy, her year end is the 30th of April. So 30th of April 22, where's that going to fit in? What do you think? Draw it out. Does it fit between those dates? Well, yes, it does. It fits in just about there. So that fits into the 22/23 tax year. So moving forward then. Now, the current year basis that we've just looked at, fairly straightforward. Okay, you know what tax year you are dealing with in this exam. It's the 22/23. So you're looking for a set of accounts with a year end, an accounting year end, that falls in that tax year. Simple enough. But the problem is, initially, when this was introduced, the rules were that you would only ever be taxed once on your profits, and you would be taxed on 12 months of your profits in each tax year. But we have a problem when you have an opening year, i.e. the year you start to trade, and then consequently, if you cease to trade, then you have closing year rules. So the opening year rules are the ones that appear the most in an exam, simply because they're a little bit more complicated. So we're going to do these special rules nice and slow, nice and easy. Okay, so these are special rules that apply in the opening tax years of trade, where there is a new trade until a current year basis assessment is available, because that's what we're aiming for. Now, the first tax year, so that's the first year in which somebody is trading and needs to complete an income tax computation. It's worked out on an actual basis, what actually happened in that period of time. In the second year, there will be several different rules that you need to check, okay, to see which one applies. All right, these are the rules. Okay, so in year one, the actual profits from the commencement of trade to the following 5th of April. When we do these in the examples, I will repeat these rules time and time again so that you can see how they work. And it's something that you will need to watch, pause, do the examples and keep practicing with. In the second year of trading, you need to ask yourself a question. Is there an accounting period or a set of accounts with the year end in tax year number 2? And again, this will make more sense as we do some of the practice questions. So, is there an accounting period which ends in tax year 2? Sometimes the answer is no. And again, we have an example that we can have a look at in a minute that will show you how that is possible. If that is the case, we're looking at the actual profits in the tax year, i.e. what falls between the 6th of April and the 5th of April. Now, the answer could be yes. Now, if the answer is yes and the accounts are 12 months long, then you're on a current year basis, which is what we're trying to achieve with these opening year rules. Current year basis is whatever falls in that tax year, and that's what we're trying to aim for. And obviously with opening years, that's not quite as easy as it sounds. So if the answer is yes and the accounts are 12 months long, then you're already on a current year basis. And we'll see that as we go through the examples. However, sometimes clients prepare accounts that are not 12 months long in that first year. For example, you might start a business as a bed and breakfast or a small hotel. Start the 1st of January, good place to start. Now, the end of that season is the end of October, so you decide that you will prepare a 10-month set of accounts just to see how much profit you've made in that 10-month period. So you've made a short set of accounts. Now, the rules are that you will, be taxed once, 2, that you would be taxed on 12 months profits. But, I'm sorry, year 2, we've only got 10 months profits, so where do I find the other 2 months from? If that is the case, then you will be assessed on the first 12 months of trading profits. And I'll show you how that works in one of the examples further down. Just to learn the rule. If it's short set of accounts, i.e. less than 12 months, then you will be assessed on profits for the first 12 months. Sometimes clients make first set of accounts longer than 12 months. So, for example, we started to trade on the 1st of January. We were supposed to end 12 months later at the end of the year. It snowed. We couldn't get in to do the stock take, so we prepared accounts to the 31st of January. That's a 13-month set of accounts. It's longer than 12 months. Rules are only be taxed once, 12 months profits, but I've got a set of accounts that are 13 months long. How does that work? This is 12 months profits you will be assessed to in the accounting period end date. So that's 12 months. In this case, it would be 12 months up to the 31st of January. Now, these rules need to be repeated. until we're on what's known as a current year basis. So if you are on a current year basis, you can dispense with these rules because you don't need to do year 3. You're on a current year basis already. But if any of those other strange rules are still in place and we're not on a current year basis, we need to repeat that again in year 3. Sometimes, rarely, sometimes again in year 4. Now, as I've said already, we're only going to be taxed once, and we're only going to be taxed on 12 months' profits. And yet, clearly, there are times when profits are going to be assessed and fall into 2 tax years, which means that that rule is not taking place properly. So, if that happens, we need a new rule. I'm sorry, there are rules. It's called overlap profit rules, where they overlap. And you'll see that as I explain that through the examples. If that is the case and you have overlap profits, you can have relief for them, relief for the fact that you've been taxed twice. If you change your year end and move it closer to the 5th of April, 31st of March, or you cease to trade.